Are you a scaling SaaS founder?
Ready to make the leap from leading a team to leading an organization? Join us each week as we refill your think tank with actionable tips and strategies from great business minds you know and those who don't know yet. This is SaaS Fuel with your host, 5-time entrepreneur, SaaS founder, and globetrotting adventurer, Jeff Maines.
Welcome back to the SaaS Fuel podcast, where our SaaS insights are like Seattle Space Needle, always iconic, cutting edge, and offering a panoramic view of what's coming next. I'm your host, Jeff Maines. I hope B2B SaaS founders like you scale from 7 figures, which is good, to 8 and 9 figures, which is outstanding. Together, we supercharge revenue growth, create premium valuation, and craft the business you're proud of and a life of impact and freedom that you love. Have you ever been to a fish market? You know, like where there are fish on ice behind glass? Yes, no, if not, I'm sure you've been to a grocery store that has like a little seafood section. Super exciting business, right? Every kid grows up, dreams of working in a seafood market. No? Sounds crazy? Of course it does. I'm glad that somebody does it because I like me some fish for sure. But that seems completely uninteresting. So picture this fish market in your mind. You got it now? Now imagine that this fish market is nationally known. People come from all over the world to see it, and it becomes a must-see tourist attraction. Now, does that sound ridiculously crazy? Well, some of you probably already know that there is one of those, and that is Seattle's iconic Pike Place Fish Market. Books have been written about it. It's a great book called Fish, as a matter of fact. The core product is pretty much the same thing that you can buy anywhere else, but the experience is way different than your typical grocery store visit or a fish market. It's a place where you are bombarded with sensory delights. I mean, flying fish, that they put on a show, spirited hollering, an aroma that tickles your nose. It's not just a fish market. It is an extravaganza. They turn fish into a fun, shared, interactive experience. And I think that data is kind of like fish on ice at a fish market. Lifeless, cold, relatively uninteresting. It's behind glass so that it isn't accessible to us mere mortals. It's protected. Only special people have access to it. But, a Seattle SaaS company changed that. You might know Tableau. Great solution. In a sea of bland data visualization tools, they're like the spicy sriracha on your avocado toast. It's unmistakable and kind of indispensable. They made data accessible, fun, and created a shared interactive experience around that. Data is consumable. It's actionable. So how can you make your SaaS business like the sriracha in a world full of kind of run-of-the-mill ketchup packets? First of all, I think we add some zest. Not literal zest. Unless you're into that, you can figure out how to put that in your solution. But uniquely targeted features that make ideal prospects say, "Ooh, that's neat. I need that." And to do that, we need to gain a deep understanding of the outcome they want and deliver +1. Zest might be simplifying a process, reducing the number of clicks, or organizing based on workflow. They just did X, next they need to do Y or Z. And are those right there, or are they 2 screens away? It's like, hey, we got that feature. It's over here somewhere. Or is it just right there? Developers and users can sometimes be on different planets for 100 different reasons. You want to make it intuitive for insiders, but that assumes some I'll say, knowledge, internal knowledge that outsiders or your prospects may not have. So make it intuitive not only for insiders, but for those outside of the organization as well. Because your users, they don't do what you do every day. They don't know your solution like you do. It's one of the reasons I love new hires is they come in and they're like, why is that like that? And you go, I don't know, because it seemed like a good idea at the time. So think about that. Next is aromatics. What is that great smell? Well, it's your brand story. Your brand story is an introduction to your company. It's a precursor to demos, solutions, pricing, and all that other stuff. Hearing about your company is like walking into a house that has cookies in the oven. Think about 2 identical solutions, one with a great brand story and one without. Guess who wins 80% more often? Yeah, you got that right. Make your story as compelling as grandma's secret recipe. I mean, so irresistible that people want a second helping. And finally, it's about presentation. I mean, Pike Place Market is a feast for the eyes as much as the stomach. They got great stuff there. Tableau made data a feast for the eyes. Your user experience should be visually appealing and satisfying, leaving customers hungry for more. We talked about UI on the podcast last month, and tech has changed so much in the last few years. I mean, features are important, but always make sure to couple them with beautiful AI, build beautiful solutions. I mean, why not? Yeah, and if design is not your thing, I hear that quite a bit. Like, I'm a back end and I'm not really a front end developer. Well, then get a designer. It is well worth it in the end. We want to make great, beautiful solutions that users love. I mean, kind of like, Tableau did with data, just like walking into the market and all those experiences. So let's cook up something legendary with our solutions. Don't just sell a product, be the extravaganza that people line up for. If you could use a little extra spice on your SaaS journey and hang out with fellow B2B SaaS founders, well, check out today's sponsor, Champion Leadership Group. It is the ultimate resource for SaaS founders and C-suite executives like you and me to continue to develop themselves, scale their companies, and never walk alone on the journey. Supercharge revenue by leveraging time-tested SaaS growth principles, toolkits, playbooks, and frameworks designed to help you scale ARR from 7 to 8 to 9 figures. Collaborate with an elite network of SaaS visionaries as we uplevel ourselves, our teams, and have some fun along the way. Confidently take that right next step that turns into a quantum leap of profitable growth, premium valuation, and freedom. You can learn more at championleadership.com. Our expert last week was Alex Kaleo, Chief Revenue Officer at M4 Mobile Research. We talked about understanding consumer behavior and bridging that gap between what buyers say and what they actually do. And our founder last Tuesday was Yaroslav Lazor, CEO and founder of Railsware. Product Studio for over 16 years has led technical teams who built world-known SaaS products and brought incredible perspective from MVP to scale. If you missed either one of those episodes, go back and check them out for sure. My guest today is a legend in the SaaS world. He wouldn't describe himself that way, but he just is. Rand Fishkin is the co-founder and CEO of SparkToro, which puts audience research at your fingertips across platforms. If you want to understand your ideal client, SparkToro is the way to do that. Prior to SparkToro, Rand founded SEO Moz. He's the Wizard of Moz. You guys probably all know. Rand has dedicated his professional life to helping people do better marketing through writing videos, speaking, and his book, Lost and Founder, which everybody should read. It's a great book. When Rand's not working, he's usually cooking a fancy meal for the love of his life, author Geraldine DeRuiter. And, if you bribe him with great pasta or fancy cocktails, he will pull back the curtain on big tech's dark secret, which is exactly how I got him on the show for you today. So welcome, Rand Fishkin. Hey, Rand, welcome to SaaS Fuel.
Yeah, Jeff, thanks for having me. Good to be here.
Well, I know a lot of people know some about your background. I'd love for those that don't. Tell me a little bit about your background. How did you start SparkToro? And a little bit about Moz before that.
Yeah. So Moz was my first company. I dropped out of college at the University of Washington here in Seattle, where I've lived my whole life, and started Moz initially as a consulting business with my mom's kind of had an old school marketing and advertising firm that she ran here in Seattle for 20 years before that. So I started doing like web design and website building with her. And then we moved to SEO. And then in 2007, we launched some software. I had started a blog that became very popular called SEO Moz. And we launched some software in the SEO space, and that really took off. We raised venture capital. I became the CEO of that company and ran it for 7 years. And it grew very fast. It was sort of riding the wave of Google's growth as well. Lots and lots of people interested in SEO, of course, as Google became the dominant force for search on the internet. And then in 2014, during a bout with depression, I stepped down as CEO. I stayed at the company a few more years, and things did not go so well for Moz, especially in those last few years. And so, I was, I think, sold in 2021 to a private equity company for a not great exit, right? I think it's venture investors would say it was I don't know, whatever you want to call it, a base hit, not a home run. And that is how a lot of venture-backed companies go. So
Sure.
one of the big reasons that I started SparkToro the way I did, that I wrote Lost in Founder, which is a book sort of about my entrepreneurial journey.
Yeah.
And the reason that I funded SparkToro the way I did, the reason I'm so passionate about alternative methods of funding is because I think venture is not right for most startups, even most tech startups and SaaS businesses. And I'm hoping over the course of the next decade or two to create some alternative options so that entrepreneurs like me and lots of entrepreneurs who are not like me at all can have opportunities to do great things and build great businesses that don't have to be billion-dollar unicorns or bust.
Right. Most of us are not building billion-dollar unicorns. That's the reality. And that's what a lot of the venture is looking for. And when you don't do that, Moz was growing 100% a year. How can you say that is not fantastic growth? But then, you do that year after year after year.
Yeah, Moz went from basically $0 to $50 million in maybe 11 years, 12 years, which seems reasonable, right? Seems like a reasonable growth path. Certainly, if you and I owned that business together, we'd be like, woohoo!
Right.
Right? But unfortunately, the reality for venture investors is, they're putting money into, let's say they raise a $300-400 million fund. They're going to put money into maybe 150, 200 companies. And the expectation is, 140 of those 150 are going to die completely, right? They'll lose all their money that they put into them. Granted, it's going to be only $1 million or a couple $1 million each. But then, right, they're hoping that those top 3 or 4 or 5 are going to make the whole fund by making them 20x, 30x, 50x their money, right? And so if you're not doing that, if you're not one of those companies, they're not really interested. And this is my core contention. My core belief is that mentality and that focus actually kills startups that might have succeeded.
Yeah.
I think a lot of companies that could have been $50 million a year, $100 million a year, $5 and $10 million a year businesses that are profitable, that have happy customers, that have wonderful products, that serve a much needed niche, that are great for their teams and for the founders. All those great companies die because they are trying to chase the billion-dollar unicorn. Right? They're basically refusing to get profitable and stay there, and instead spending themselves into oblivion, trying to get faster growth so that they can, raise their next round and please their board of directors and get to the numbers that folks are looking for. And I think it's a dumb game to play. I even think it's a dumb game to play for investors.
Yes.
So
agreed. Yeah.
Yeah. Jeff, I don't know if you invest in startups, right? But like Geraldine and I do a little bit. We don't have that much money, right? So we can't invest in 100 companies, but we can invest in 4 or 5. And so because we can only invest in 4 or 5, we can't take the risk that, 140 out of 150 are going to die, right? Those odds are terrible. We're never going to be able to cover our bases, right? We can't play the game at the scale that a venture fund can. For us, the smart bet is, how do I beat the 5% interest that I could get from a treasury bond? That's the real question. And the answer to me is, if I'm going to invest in 5 companies, I need 4 of them to get to profitability and then hopefully pay me back my money and maybe pay some dividends and maybe sell at some point in the next 10, 15 years. That's all I need, right? I don't need my 10x return, my 100x return. I'm looking for a portfolio of businesses that look a lot more like restaurant investing, which I know sounds weird, but there are a lot of people in the food world who invest in restaurants, which are supposedly this crazy high-risk business, and they do fine because restaurant survival rates in the United States are massively higher than startup survival rates. And I think that's madness.
It is.
Yeah. Anyway, that's my long spiel, philosophical whole thing, but that's what I believe about the SaaS world.
Well, that's fantastic. And I love the book, Lost and Founder. I think you really went into a lot of that there. And in SparkToro, you started differently than Moz. And I talk to founders all the time, and the Silicon Valley way is, I mean, like you say there, I mean, it is not the way for most companies. And even if you are going to take on investment, waiting a lot longer than, hey, I've got an idea. Let's take on investors now. Let's go prove an idea. Let's make some money. And the longer you can delay that, the better it is. And with SparkToro, you did it very differently. Talk about that.
Yeah, absolutely. So when I left Moz, it was not a fun experience. It was a pretty terrible transition. I half quit before they mostly fired me, right? And that process was very painful. It was also the case that we did not have significant savings when I left Moz. I'd never made as much as even like a mid-level Microsoft engineer in my career, right? So I owned a lot of stock in Moz, which was essentially what my board told me was my compensation. Like, well, you own so much of the company, we can't pay you more than, whatever it was, $160,000, $170,000 a year. Which, don't get me wrong, that's a fine salary. It's so much more money than most Americans make. Like, I'm not complaining about it. I'm just telling you this because when I left, I did not have the funds to bootstrap SparkToro myself. Right? There's no way that I could be like, hey, Casey, I'm going to pay your salary and my salary and our healthcare, and we're going to pay all the Amazon Web Services costs and all the data acquisition costs and the API costs, and like, we'll build this whole thing ourselves, even if it takes us 2 years to build. It'll be fine. I'll cover it. I couldn't do it. There was no way, right? I did not have the resources to do that. I did get a nice severance from Moz, where they essentially covered my salary for a good number of months after I left, and so that kind of helped me get going. And I immediately went to fundraising, but I had to fundraise in an alternative way. And the way I raised was from a lot of folks, like yourself, Jeff, right? So a lot of other founders and people I knew in the marketing and SaaS and startup world who I'd built relationships with. And my pitch to them was, we're going to raise $1.3 million for about, you're going to, investors own about 25% of SparkToro. So the, pre-money, I think, was 4 million, post was 5.3. And we are going to cap our salaries. We're going to get the company to profitability using your investment. And then we're going to pay back the money that you've invested in SparkToro. And after that, everybody participates in dividends for 10, 20, 30, 50 years pro rata. So according to your ownership. And if the company ever sells, you'll get that percent of your ownership as well. But the idea was, we're going to use this money to get this company to profitable survivability for the long term, not we're going to grow as fast as we possibly can. And that is exactly what we've done. We actually wrote checks, felt really great earlier this year. We wrote checks to all of our investors, paid them back the full 1.3 million. And once we did that, Casey and I were able to increase our salaries. We had that written into our founding documents, right? That essentially our salaries were capped at the Seattle software engineer average. And after that, we could bring them up to, I think, up to 2x that level. We didn't bring them all the way up, but that's what we did. And so, I think it's a very fair way to invest. And I think it's a very fair way to build a company. Even if you're going to build a $100 million, $1 billion company, why not raise money that way to start? See where you're going, see what your trajectory looks like, see if you can get to a sustainable, profitable business that's growing, and then identify those growth levers and say, okay, you know what? We could raise another 10 million and do outstanding things, as opposed to putting yourself on a track that limits your options going forward. That's my belief, and that's why we raised money the way we did with SparkToro. And I'm encouraging a lot of other folks to do it too. We open sourced our operating agreement, our fundraising documents, so that anybody can take them, put in their own numbers and data and whatever, and save a lot of money with their attorneys if they want to go fundraise this way. A few companies have. There's actually a fund. I don't know if you know, I'm sure you know Rob Walling, MicroConf, right? So Rob's fund, Tiny Seed, uses the SparkToro structure as the basis for how they do their investments, all their funds. Yeah, which is really cool.
Really, really smart way to do that. Because the venture money comes with some pretty significant strings attached, and that growth at all costs. I've been there. You build a company that, in my case anyway, I built a company I hated. I didn't really enjoy it anymore. It wasn't fun. It wasn't what we started out to be. Yeah. And then you're like, well,
how big did you guys get? How many people?
That one we're right at 100 people.
Yeah.
Yeah.
Yeah. I don't love once we got sort of north of 25, 30 and you stop having close relationships with all the people at the company, I don't like the politics of it. I don't like that kind of size for me is just not tenable and not enjoyable, right? And what the heck are we doing here, right? Like, what are we really on the planet to maximize shareholder earnings? That doesn't seem...
Yeah, can't there be a better mission than that?
Yeah, it's got to be something else, right? Like life must be about more than how do I make sure that my investors get the most money back from a sale, or how do I make sure that instead of becoming a whatever happy, healthy human being with lovely friends and wonderful family life and all those things, I instead put the largest number of zeros behind my bank account that I can.
Yeah.
I don't know. Yeah. That doesn't make sense to me.
No, there has to be more. And I think it's really sticking to company values. What did you create the company for? What's your mission? Why do you exist? And I don't know any company that starts out and their mission is maximize shareholder value. The end. There's got to be more than
all
that.
All the public companies get there, right?
Yeah.
All the public companies go from, Google, Google is a company I followed obviously very closely for years.
Sure.
I thought extremely highly of them. Probably, their first 10 years of operation until they went public, that company was so impressive to me, right? I didn't agree with everything they did. I gave them plenty of criticism on stage and off, but I cannot argue that they didn't change a lot of the culture around tech. And I think that in the process, they actually built a pretty positive reputation for the technology and startup world and the Silicon Valley startup world in general. And then they went public, and then Facebook came out and they went public, and The Social Network, the movie came out, right? And you were like, I see what happens to what I thought were good people and good companies when the incentives of growth at all costs overwhelms everything else.
I call it being successfully stuck. So you have so much success and you can't get off the hamster wheel. You can't stop because you have to please investors, and it's exhausting.
Yeah, I'll give you a really salient example from what's going on with SparkToro this year. So for folks, I don't know how many folks are familiar with what we actually do. We do audience research, mostly for marketers and a lot of researchers, market researchers, plenty of folks in tech, founders, startups, that kind of stuff. But our data set was centrally connected to the Twitter API that gave us the follower-following relationship, right? So we could see what about 350 million people who use Twitter, what all of them followed, and what they were followed by, who they were followed by, right? And so that interest graph and following graph was our starting point for the data set that SparkToro comprises. And then we built out from there to 13 other social networks and the public web and podcasts and YouTube channels and all these other kinds of things, right? So, but the core of that data set is those connections. When Elon bought Twitter, of course, he deprecated that API entirely. You can't even pay for it. So even if we wanted to pay for it, we couldn't. And as a result, this year has been a year of complete retooling. Like, we basically are entirely rebuilding our infrastructure. We haven't released a new feature this year since January, right? And we're probably about 60 days out from having this new version of the product ready, which uses other data sets and other data sources. I like it better. I think it's going to be better for our customers. But, it's one of those things where if we were in venture world, we'd have been done.
Right.
Just sunk, right? Because we basically are at, I think we're about a 15% decline in revenue from our high, which was March, right? So we basically, we grew at the start of the year and then have been, not like this, but, a slow, steady, bleeding a couple thousand, $3,000-$4,000 in MRR every month, right? Because more people are quitting than are signing up, and the product just isn't quite as strong. And we obviously haven't been able to do as much marketing, right? So, hey, it's frustrating. It's still a great product. It still does a lot of things that a lot of people want. People are still signing up every day, which is nice. A lot of people are still using it. That's great. Like, we're very happy about the loyalty that our customers have shown and the fact that the product continues to provide value. But we know we got to get off this old data source. And as a result, we sort of tune down all of our other efforts. And there's only three of us. There's only three of us at SparkToro, just myself, Amanda, and Casey. And frankly, we, we could have been horrifically stressed and like bent over backwards to try and maintain a growth curve, but it didn't make sense. Like, we needed the time to retool. My suspicion is, if we talk again in a year, I'm going to be able to tell you that was one of the best things we ever did, right? That just taking it slow, making great decisions, not being stressed out about it, having a good personal and professional year, and then rebuilding the product and launching that, getting that to growth. I think it's the right move, but it would be something that, at Moz, I never could have pulled off.
Right. Yeah. Just because of the strings attached, you don't have the option. And so I think you're right that a lot of times those types of trade-offs happen in companies that you don't have the option. Certainly taking money, especially early, takes away a lot of those options, whether that's to sell, whether it's to raise, whether it's to take some time and revamp the product, take a step back, pivot, whatever it is. Having those options is priceless, and being able to build and do what's right for your customers, do what's right for the industry, build something that is still continuing to impact, not like, well, shut the API down, so we're done. No, there's so much more.
Yeah. I mean, I think that there are really kind of two options, right? It's send your extra money back to your investors and like shut down and that kind of thing, right? Which a lot of companies do.
Yeah.
Or it's, how do we try and power through this and burn the rest of our capital and hope that we like find that growth curve again before we die? And a lot of companies do that too. And I don't think either one is a great option. I think the ability to be, because we were profitable, we're still profitable. I don't know. I was looking at our our finances for August, and I thought to myself, this is technically more profit than Moz made a lot of months, right? With 50 million, but because it was always spending more than it was making, because it was trying to get that growth curve, right? That the VCs were looking for. So it's just a different world. I wish I could convince people, more people, to think in this way, because I think it's not that big a mindset shift, but it changes your whole life and world, and it changes how well you can serve customers and what you're aiming for. I think profitability and sustainability and the ability to power through bumps and not be worried about proving growth every single month of every single year, having some down quarters, being okay with that. Wow, man! I mean,
that's the normal life in a business. Is you have those ups and downs. I mean, everything is not always up and to the right. I mean, no matter what you read in TechCrunch, that's not how it works.
Exactly. Yeah, I've been noticing. I've been getting in my Google Discover feed. I've been noticing, TechCrunch. I think today or yesterday they had a popular article about how like bootstrapping is hot again.
Yeah,
and I had this thanks publication that's trained us for the last 15 years to think that bootstrapping is the least cool. They use the pejorative lifestyle business bullshit all the time. And
serious founders don't do that.
Well, Jeff, I'm really glad that SaaS Fuel is the kind of podcast where we can have this conversation. I was a little nervous going in. I was like, oh man, is he going to be like, what are you talking about? Go big or go home.
No, I think that it's growth at all cost is dumb. Deciding we're not going to make a profit is dumb. Fundamentals matter. And, I love growth, love taking care of customers and building solutions that matter. But I mean, business is in business for a reason. And one of those reasons is to make money. And if you can't find a way to do that, then something is fundamentally broken in the model.
I'm probably tell from my background or following me or whatever, right? I'm a very left-leaning person, sort of politically, generally speaking. I don't know that I identify with all of the labels that one might put on someone like that, but I have lots of critiques of capitalism generally, and especially late-stage capitalism. In my opinion, the job of a responsible government is to be responsible in regulating capital and industry so that it's fair. Right. And for example, right, the Department of Justice is suing Google right now for all these unfair monopolistic practices that violate antitrust law. Right. And The reality is that I think a lot of people over the last 20, 30 years, especially young folks, like the generation just right behind us, even a few years right behind us, I think feel cheated by the promise of capitalism of the prior 100 years. And I think fairly. I think they feel cheated fairly because a few big companies and a small number of very wealthy people have continued to consolidate wealth at the expense of kind of broad wealth for the rest of humanity. I think that sucks. I think it's dumb. And I'm not sure that the solution is, whatever, full on communism or I'm going to say like large S socialism. I think social programs and stuff are great. But in my opinion, there are responsible market-based solutions. And one of the ones that people like you and I and everyone who's listening to this can contribute to is building small and medium profitable businesses in niches that serve customers well, build a great product, that serve their employees really well, treat them well, pay them well, reward them well, and serve small investors. Even people with a few million or a few tens of millions of dollars are, like, when you look at the stats, they're not the problem in the wealth consolidation game, right? It's people who are sort of, I don't want to say people, right, and not everyone, but like in the $100 million and $1 billion and up club, that's where most of the consolidation and problem come, right? It's like the top 0.01%. That's where most of the wealth has gone. And I would contend that it's actually a wonderful thing to have more diversity in companies, like a broader number of companies doing well in a space versus one company taking all the money. And venture, my like core contention, I don't even know how venture capitalists argue against this. My core contention is that venture is all about rewarding one company, a couple of founders, one investor and their LPs at the expense of thousands of others, right? They are monopoly builders by trade. That is their goal. They think that they'll be happy to tell you, they think that in every space there's one winner.
Right.
And they want to back that one winner, right? And saying that publicly is weird. Like, it's, I get that it's accurate from their perspective and from their financial interests, but it's freaking weird to be like, wealth inequality, oh, I love it. In fact, I spend my whole life trying to create more wealth inequality. What do you do? It's just a weird opener at a party, right? But like...
Well, that's one of the things that the SparkToro has done is really democratized data and market research and brought that down from the big companies to the small and normal businesses to have access to that they can act on. So was that one of the goals in the beginning?
Yeah. Oh, absolutely. Absolutely, Jeff. Yeah. So I think, obviously this philosophy that I have around whatever sort of economic opportunity and all these other kinds of things also flows into the product. And so, and it connects with how you have to build a business if you are going to be practicing kind of the thing that we do, which we call chill work, right? Essentially, we aim to have French working hours, 30, 32 hours a week at most that we're focused on SparkToro, and plenty of time for vacations and family and prioritizing other things. And in order to do that, we needed a product and a company that did not rely on kind of classic SaaS-based service model, where enterprise sales, big customers and clients who are paying hundreds of thousands or millions of dollars, and you've got to service them right away. If they ask for something, you've got to bend over backwards for them. Sales calls that require lots of time every day. There's only 3 of us, right? So if we had 30 hours of sales meetings a week, right, or calls, that'd be it, right? That'd be like that's 30% of your company time, like, gone. And so instead, we built a model that was, let's take this thing that big companies have through, for example, Brandwatch, which is an enterprise. Sure. They do all sorts of things like social listening and monitoring, social media monitoring, and they have an audience research product as well, which is very good. It's a very good product. I would be willing to say it's better than SparkToro. Probably for most, if you're an enterprise, especially, it's better than SparkToro. But it will also cost you, I think, at minimum like $100,000 a year. And SparkToro is $50 a month, right? So our, our model is, how do we make that thing which has historically only been available to these big companies with these huge budgets, long sales cycles, enterprise levels of service, all that kind of stuff? How do we bring that down to everybody? And by doing that, we do two things, right? We broaden the market. Like we say, essentially, hey, all these people who could benefit from this data that only big companies have, could they build better businesses? Could lots of small and medium businesses, lots of marketers do better at their job by having this information at their fingertips for a very low price? I mean, we offer a forever free account too, which is very popular. I think we have like 110,000 people who use the forever free plan, which is great. Like, I love it. That's my whole thing is like, hey, if the top 5 or 10 results that you get in the forever free plan are all you need, awesome. Like, go use it, right? And then you come pay us when you want more, you need more, you're doing more. Wonderful. I think that's outstanding. And philosophically, this works really, really well with a business that can scale at a low cost of customer acquisition and with a high margin per customer, which is a quite different model than a lot of SaaS businesses. But, as long as the market's big enough to support a company like ours, and, I think audience research is we probably have, we could probably grow 100 times our size, if we were, if we were going all out. But that fits really well. And I've been thinking about writing a sequel to Lost and Founder, and a big part of that, I think, is like the design of the business, right? It's like how you design and structure who you serve, why you serve them, what you serve them with, what you choose to do, and really what you choose not to do, which is almost more important.
And when you say choose what not to do, is that in building the company or the way you structure it? Or tell me more about that.
Yeah. Everything, right? So choosing what not to do. For example, you and I were chatting earlier about how neither of us really likes to run big companies of hundreds of people. So we chose, right? We said basically, we don't like that. Casey and I don't like that. So we're not going to do it. By taking that off the table, we also remove the idea of, hey, we're going to have a big sales team. Can't have a big sales team. You can't build a sales-based enterprise SaaS business, right? So we remove that method of acquiring customers and serving customers. What's left to us? Self-service. Okay, right? So the sort of decision-making that you do around the life you want to lead and the business you want to build informs how you strategically make the rest of your decisions in the business. And this is what I mean about like designing the business around what you are not going to do, in addition to what you are going to do, right? But I think a lot of founders feel this pressure to make the company successful at all costs. And by successful, I mean, at venture scale or close to it. And so they don't take options off the table. They invest small amounts of effort and energy into a lot of different tactics, whether that's product tactics, sales tactics, marketing tactics, financial tactics, fundraising tactics, whatever. And as a result, distraction and scope creep and lack of productivity are natural results. Right? Yeah. If you do one thing and you're really good at that one thing and you love doing that one thing, you got high odds of success, my friend. Right? And if you choose to do 10 things and you're kind of good at 2 of them, but not really good at 5 of them, and you're real bad at the last 3, no. We've all been there in life,
yes,
right? I don't care whether you're talking about your home life or your romantic life or your, whatever. You play sports and you're particularly good at one position and you're not so great at these other parts of that particular sport. This is true of all humanity. We are great at specializing. We as a species are great at practicing something and getting better at it. And when we like it and fall in love with it and do it over and over again, that's where magic happens. And where disaster happens is when you spread yourself thin and try to be good at everything. This is also true in company building, and yet I see a lot of early stage, even mid stage founders, right, who are struggling, and so they're throwing spaghetti at the wall, trying to make something stick. And my argument would be, this sounds weird. It sounds counterintuitive to like American culture, but think smaller, niche down, do less. You might actually do better, be happier, build a happier set of customers, build a happier team. I've talked to a lot of people, especially the last couple of years, where there's been some, significant funniness. I don't know exactly what to call it. Declines, changes in behavior, right? I think because the pandemic sort of grew this massive investment in digital of all kinds, and then of course, everybody divested as COVID was lifting, et cetera, et cetera. And I've talked to a lot of founders of companies who sort of are in this like state of feeling like they have to maintain the growth that they had 2 years ago or a year ago. And I just don't think that's the right answer. I don't think that's reasonable. I think that sometimes you got to make the cut and the decision to downsize and focus and be really good at that one thing. And that, what's awesome about that, it makes marketing so easy.
Yes.
It's so easy. It's so easy to be one thing for one type of person that serves exactly one goal. And it's really difficult to be, oh, well, we're audience research for everybody, big, medium, small, no matter what business, no matter if we're talking about social media or content marketing or SEO or like all these things, we're everything. Your messaging is real tough. Your advertising is going to be real tough. Yeah. But you do one thing, works.
So what is one of the big marketing myths that you've seen? You've been doing this for a long time. Marketing myth that just needs to be busted.
Ooh, this was not always a myth, and I think that's actually why it's so pernicious and strong. Marketing attribution is dead. I'm not even going to say dying. I'm going to say it is dead. And what I mean by that is, if you go back in time 7 or 8 years, nearly every place on the internet that could or would send traffic supplied a referrer string. Yep. Every browser supported third-party cookies and full, not even 90-day cookie windows. You could track people for years, right? So I could say, oh, someone just signed up for SparkToro. Well, at the time I was at Moz. So, okay, somebody just signed up for Moz. Let's look at the last 2 years of their visits to our site and all the channels and tactics that brought them to us. And then we can do an attribution model that basically says, oh, okay, well, events was this much, podcasts and YouTube channels and webinars was this much, content was this much, SEO was this much, paid search was that much. Boom. All right, there's the attribution for that one person. Now let's do it for the next 10,000 people who sign up. And now we've got like a very, very impressive attribution system. And most sophisticated companies were doing that. And then 3 things happened. 1, ad blockers and privacy laws changed, right? And so basically a huge portion of essentially all your EU customers and a number of other jurisdictions, including California and Canada next year, a lot of that data not available dropped. The cookie window went from infinite to 90 days. It might be shrinking again soon. Third-party cookies declared illegal, right? And in the EU, and Chrome, Safari, Firefox, the 3 major browsers, dropping third-party cookie support entirely. Completely different world. Oh, and then the last one, dark social, right? The rise of dark social. So essentially, tons of sources. TikTok's a great example of this. Any link on TikTok, and they're almost all bio links, right? Because they won't. I think they do let you put some links in some other stuff, but they all carry no referrer string. So you have no idea if TikTok sent you an organic visit. Nobody does. TikTok blocks it entirely. LinkedIn blocks a bunch of them. Reddit blocks some. Facebook blocks 25%. The only one who still carries it is Twitter. But of course, all of these platforms also, in addition to dark social, they have all bias to native content, right? So Twitter, in the algorithm that Elon open sourced, he showed, hey, we penalize a tweet's visibility and engagement if it has a link in it. because we don't want people leaving the site.
That's true across all social platforms.
Exactly. So all these things happened, and marketers are still told by their bosses and teams and clients, show me the attribution. It's not possible. All you're going to see are the attribution channels that are still available to you, which are the paid ones.
Right.
And big tech loves that. Big tech loves that because it means you're going to put your money into Apple, Amazon, Google, Facebook.
Right. Yeah.
It's just dumb. So attribution's dead. It is a marketing myth. It used to be real, right? Like you're not dumb or foolish for thinking like, hey, wait a minute, didn't this attribution thing, didn't I learn all about how to do that and these models and I saw them in my previous companies? Yes, you did. And they are wrong today. They are absolutely undercounting every organic investment you can make. They're undercounting word of mouth. They're undercounting PR. They're not counting content. You're missing out on tons of SEO stuff, right? Keyword not provided that Google changed in, 2014, 15. So all this, it's just gone. And so you're getting a completely biased picture. If you invest in marketing on an attribution basis, you're making mistakes.
That's really, really good. Is there still a way to track organic, or how do we measure that? Other than just asking.
You can. So I wrote this blog post about how to measure hard to measure channels. So if you Google hard to measure SparkToro, you'll probably find it. And you can build models that use. It's not attribution though; it's measurement. Measurement being things like I can measure how many new followers I got. I can measure how many impressions I got, how many engagements I got on a platform. I can measure how many people saw a thing. I can measure how much traffic I got overall, right? So, if folks are listening to this podcast, for example, and they're like, oh, this SparkToro thing sounds interesting. I want to learn more about audience research and what Rand's up to. So they go to SparkToro.com and they sign up for an account. We'll never be able to know that it was because of the SaaS Fuel podcast. Like I can't prove it. But in the 2 weeks after SaaS, this episode launches, I can look at my traffic and be like,
you see a bump.
Does it look about 10? Yeah. Like, does it look about 10% higher than it normally does, right? Than the trend would have suggested? Yeah, it does. You know what? I think that like these 100 signups probably came from SaaS Fuel or, whatever it is. So it's time series measurement based stuff. And that a lot of CEOs and CMOs don't believe in that, right? They've been trained not to.
Right.
If you go back to, what's considered like the golden age of brand advertising, right? The 1950s, 60s, 70s. Basically, this is how Coca-Cola chose which billboards to run in which cities. Right. They put up a billboard on Michigan Avenue in Chicago, and then they looked at same-store sales over the next 3 months, and they said, we saw a 4% lift in same-store sales of Coca-Cola and, whatever the rum we were advertising that we also earned. And okay, that's what we're going to do. We're going to run that billboard. That was way more successful than the one we put in Detroit and the one we put in New York. Sorry, I hate to bring you back to 20th century style marketing measurement, but that's the world we live in because the technology has been rendered obsolete. The only people I think who can still do the full attribution modeling stuff and rely on that are really big companies who are investing tens or hundreds of millions of dollars in almost exclusively advertising-based channels, and they're really just trying to test their digital advertising. Fine. For you, yes, Google is happy to provide you with, the keywords. So even though supposedly it's a privacy problem, they'll give it to you if you pay them, right? Facebook is happy to provide you with full funnel attribution. Amazon's happy to show you all the product data, YouTube, TikTok, whatever, right? So the ad platforms, if that's the only place you're doing your marketing, fine. Everybody else, you're out of luck.
It's definitely changed. I think this really, really interesting perspective because I haven't heard anybody else say it like that. So I think that's really, really helpful.
I mean, it's weird because I feel like when I talk about this stuff, I think marketers know, right? Like they know these things are happening, but maybe just haven't considered the implication of it. When you're like, oh, okay, all the browsers are killing third-party cookies. Oh, okay. Google took away keywords. Oh, okay. The EU, banned Google Analytics. Oh, okay. 90-day cookie, or whatever. Cookie windows have shrunk to, even first-party cookie windows, right? Have shrunk to 90 days or whatever. And I can't, I can't see all these refers because of dark social. And all the platforms are penalizing content with links. And you combine all those things, the outcome is real obvious, right? Like I'm not a rocket scientist here coming like, I'm on my whiteboard with all my formulas or anything. It's just, this is how it is, man.
The platforms want the attribution for themselves and their paid channels. And then they don't want to give it for anything else.
I mean, think about the incentive, right?
Yeah.
If you're Facebook, Google, Apple, Amazon, you're kind of like, I love this, right? I can basically get marketers who were trained for the last 15 years to only invest in attribution provable channels to put all their money and budget into paid. Right. That's great for me. Of course, I'm going to encourage that.
Well, one of the things that I love about, SparkToro and what you've done with your business as well, and other entrepreneurs is giving back to the community. So we're not in business that we're talking about just for ourselves, but there's a lot more that we can do as entrepreneurs, and as we create wealth, and then that's shared. And so one of the organizations you support, and even when you speak, is givedirectly.org. Tell me about them.
Yeah, I love these folks. I think they're really counterintuitively, and the reason is, so a lot of people, doesn't matter your political beliefs, like a lot of people have the impression that if you just give folks who don't have much wealth money, that money will not be spent wisely, right? So if you, go to a poor community in a country in Africa or in a European country or in the United States, Give Directly during the pandemic started operating in the United States as well, because turns out we have some of the worst, most pernicious poverty in the world, which is pretty embarrassing for the world's richest country. And so essentially what they do is they'll go to a place like New Orleans, for example, right? And they'll have an application process for folks, and they'll basically, you kind of submit your finances to them, and they will say, okay, here's $10,000, right? And then they track what happens to that person and their family, the people that they live with over the next 2 to 5 years, right? So they do a little bit of research in here. And they're essentially like, the outcomes are incredible. People start businesses, people pay off student loans, people get out of debt. They manage to take care of their health and medical care, which means that they can get jobs, which means that they can, sort of increase their family's economic status and productivity and all this kind of stuff. And then that creates more opportunity for the community around them. If you take a community of 1,000 folks, in a small region that are poor, and you make 100 of them suddenly sort of, much more well off, not even necessarily rich, but more well off, like the other 90 benefit as well. It's
right.
just how it goes, right? So Give Directly has some awesome research around this. And when I read up on it and read some articles about them, I was like, gosh, I kind of love this. And what's great about it too is the overhead is so small, right? So being a software entrepreneur, I really like margins, right? And so in the nonprofit world, I love this idea that, oh my God, all this money, $99 of every 100 goes directly, hence the name Give Directly, right? Yeah. Goes directly to folks who need it. And then you can see the outcome, like it's evidence-based, outcome-based. It's just great. I also, because I'm such a contrarian, I love that most people think it's going to go to drugs and alcohol or, bad things. I don't know what other bad things, but nope, that's not how it is. Turns out people who are poor are not dissimilar to people that are rich. They want good lives for their friends and family and their community around them, and they will invest positively. And if we can get rid of that bias, maybe some more folks can benefit. So anyway, Give Directly.
I love that.
It. Yeah.
Fantastic. We'll make sure and drop out a link in the show notes for that as well. Where can people learn more about you and about SparkToro online?
Yeah. So I have this book, Lost and Founder. I am most active on social media right now on LinkedIn and Mastodon. I'm hoping that Threads is going to federate with Mastodon, so you'll be able to follow me on Mastodon on Threads soon.
Okay.
Yeah, and SparkToro obviously is totally free to create an account and play around with it as much as you like. We don't have a free trial. You don't have to put in a credit card. It's just totally free. So feel free to have a look at that. And hopefully soon, Jeff, I will have an announcement around another book. Probably next year.
Awesome. I can't wait for that. Make sure and link that in the bio and Mastodon in the show notes as well. So, Rand, it's been
Wonderful.
a great conversation. Really appreciate you being on SaaS Fuel.
My pleasure, Jeff. Thank you for having me. Take care.
Thanks again, Rand, for coming on the show and sharing your journey and insights. Man, super, super value from someone who has built an amazing business twice and in two totally different ways. You don't really see that often, and I know how difficult that is. Huge respect, and he's amazingly candid about the process as well. You can learn more about Rand and SparkToro at SparkToro.com. And be sure to pick up his book, Lost and Founder, because it is so good. All links, highlights, resources, and full show notes are available at SaaSfuel.com. And of course, check us out on YouTube as well. Subscribe or follow us there. Share this episode with a friend. They will thank you and think that you're super smart for referring the podcast to them. Everyone who subscribes this week gets a craft coffee starter kit for kids because, it's never too early to train the next generation of coffee nerds like me. It includes a toy AeroPress and foam art stencils. It's kind of funny, but now I kind of want some coffee. How about you? Well, join us Thursday on our SaaS Fuel Expert Series, where my guest is Mike Porter, president at Print Mail Consultants. Mike and I will talk about content marketing strategy, how to engage the SMB market, and deliver content in surprisingly effective ways. And next Tuesday, we have founder Greg Rich. He is a tech CEO whose entrepreneurial roots were watered not by Silicon Valley, but by a family business and a stellar help desk. He is a rare blend of customer service fanatic and tech-savvy leader who's turned experiences into empires. That would be a great episode, so I look forward to seeing you then. Be safe if you and the kids are going out tonight, and I will see you next time. And as always, enjoy the journey.
Thanks for listening to SaaS Fuel. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at SaaSfuel.com. Be sure to follow and subscribe wherever you listen to podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/SaaSfuel. We'll be sure to read these out on future episodes.